Hi, welcome to Let's Talk Bonds, the fortnightly podcast from INR Bonds. I'm Arjun Patsarthi. A lot has been happening in the markets, and regulatory scrutiny is definitely increasing on lenders. A lot of regulatory actions have been taken in the last couple of months. The most recent one being the one on Paytm, where RBI has put a stop to a lot of businesses of the Paytm itself, and that is really affecting the performance of the whole company. The equity price of Paytm has collapsed and has been on a lower circuit for the last couple of days since the announcement by the RBI. Now, this shows that I will not go into details of why, what, what's the main reason why RBI is coming out with such heavy hand on Paytm, but clearly they have found irregularities and they are addressing that very sharply now. And earlier they had come out saying that investments by lenders into AIFs is leading to evergreening of assets. And they have put a stricture saying that any lender investing in an AIF has to has to provision for 100% of their investments. And that is also affecting the lenders, which is RBI calls them regulated entities. But most all the regulated entities by RBI are lenders largely. So many lenders have started to make provisions, and they could be making more provisions by the end of March for this quarter, because that uh, the regulations they gave a time period of 1 month from the time they came out with regulations, and that ended in the last week of January. All put together, are the regulators are definitely more and more inclined towards heavier regulations, and largely because one is that they don't want they are seeing they could be seeing a lot of froth in the market, especially given that credit growth has been very sharp, over 20%. The equity markets are very strong, and there is a lot of other there are a lot of other investments, that is liquidity that is flowing into a lot of other asset classes, which the regulators want to make sure that it's safer rather than leading to any kind of financial instability. Now, how does the whole regulatory scrutiny affect the lenders in terms of their businesses? Yes, obviously the businesses also get affected, but lenders also issue bonds to borrow. And if these lenders come under scrutiny and the businesses are affected, and some of them have very strongly contravened the regulations, then they could also mean they could have some liquidity issues. So it could be that bond deals of lenders, especially the ones that the public see as not very well governed or have governance issues, could face issues, and there could be yields could be trending up sharply. The credit rating agencies could be also more cautious on the ratings there, and liquidity could dry up from other sources as well. And this could lead to some of these lenders having issues in repayment. But as of now, there is no clear signs of any of these lenders in a distress. But clearly, with the regulatory scrutiny happening, we find that many lenders have started to undertake more intensive audits of their profiles, of their business profiles, and they're pointing out to any inconsistencies that needs to be repaired. And many of these inconsistencies are easily to be can be easily repaired. But if there is something that the markets is getting a whiff of in some of the lenders, then clearly it's reflected in other areas as well. So all put together, bond deals of issuers, especially the lower rated issuers, lenders who tap the bond markets regularly. Now, some of them, if the market believes that they could be facing some kind of a regulatory scrutiny, they could come under a bit of liquidity squeeze, which could push up the yields. This is just a risk warning by both regulator and the market itself can recognize this risk warning and may take it as a sign that it's better to be more cautious as of point in some of the bonds that they want to invest in, not all the bonds. So it's very important to be very careful on the kind of issuers that you want to invest in. Having said that, there are many issuers who are uh, doing very well and have very strong governance and reporting. And these are the issuers that investors need to look at. I'm not going to go into names, uh, but clearly investors need to now start to look at each issuer in perspective. And platforms like INR bonds provide all the information that investors do require to make sure that they are investing in the right issue. It's better. There has been definitely a search for yields by the investors in the market, and a very high yield bonds. If investors should not get carried away by the higher yields offered in bonds, they should see what kind of risk these higher yields are carrying, and do they come in? Are they commensurate with the returns that can get from these issuers if things go wrong? So it's better to be very watchful of what kind of investments and what kind of risk investors want to take in lenders who are offering bonds at higher yields. Having said that, if investors have done their due diligence and taken all the information that is required, and again coming back, platforms like INR bonds, we provide all the information that you require, complete transparency in what you need to know about the issuer in both in terms of bond prices as well as all that information that we can get from published sources. And you can then investors can take their own can take much a more informed decision on their investments. The regulatory scrutiny, I think, is going to get tightened as we go along because we have had a lot of many high profile events. It started off with failure of IL&FS and DHFL, which definitely hurt a huge amount of sentiments in the market. And many investors have been caught out in this and lost a lot of capital. And then you had the S Bank debacle, where many investors in the that tier one bonds, the 81 bonds, lost their capital as the bonds were written off. And some other events have also been happening slow one by one. And we have also seen that RBI is also now coming down on a lot of unregulated platforms that are coming up, um, issuing loans in various products. And some of them they have regulated, some of them they have completely banned. So they'll be more and more watchful because one is they don't want investors to get caught out. And they also don't want any kind of a financial instability in markets. And with RBI increasing scrutiny, other regulators, including SEBI, will also increase their own scrutiny and come out with a very strict policy on unregulated platforms and investments. So given all this, the environment is definitely more of in terms of getting risk aversion at this point of time, at least in terms of some of the lenders. And so investors will definitely be more watchful in terms of what kind of bonds they want to invest in. And they may not necessarily go with the pure yields that are the returns that are offered by the bond, but they would rather like to go with a safer bond, which even offers a better, lower yield, but at least the risk return profile is much better. Thank you for listening in. Do follow us on all podcast channels. And INR Bonds is offering you the best information. And you can download our app, Quick Invest, by INR bonds to see what all the bonds, all the information that is being available, made to you, publicly available to you, and you can take your investment decisions accordingly. The clearly bonds do carry default risk, and investors have to be aware that any bond apart from a government bond, which is a GSAC, all carry credit risk, which means that bonds can definitely default if their fundamentals are weak, or the fundamentals get very poor. Thank you very much.